Welcome to Talk Tickers. Today, we're going to dive deep into Lemonade's Q1 2025 earnings call.
That's right. We'll cut through the noise and give you the key insights.
Our goal, as always, is to pull out what matters for you, the experienced investor.
So, looking at the big picture for Q1, generally positive, wouldn't you say? Strong growth year over year on key stuff?
Yeah, definitely positive momentum. Top line growth accelerated again. That's, 6 quarters in a row now? A 27% jump.
It is. And what's maybe even more telling is on the expense side. If you strip out the growth spending, their core expenses have actually gone down in real terms.
Over 10 quarters.
Yeah.
Even while the business itself grew massively.
Over 65% bigger book, right?
Exactly. That points to some serious efficiency gains starting to show through.
And that means gross profit growth is now outpacing fixed cost growth.
That's the key metric for operational leverage. Yeah, it's heading in the right direction.
Yeah.
And they stuck to their target for EBITDA break even.
End of next year, correct?
End of 2026 for break even, yes.
Right.
They reiterated that. And they held firm on the 2025 EBITDA guidance too. Actually nudged up the gross premium and revenue outlook slightly.
They did. And even with those California wildfires, which were, significant.
Definitely significant.
They still expect to be positive on adjusted free cash flow for this year, 2025.
Okay, let's talk about those wildfires. They clearly had an impact on the quarter's loss ratio.
Undeniably. Added about 16 percentage points to the gross loss ratio just for Q1.
Ouch. But the longer view, the trailing 12 months.
Still stable, came in at 73%, which is still within their target range. So one bad quarter for cats didn't derail the overall picture there.
And adjusted gross profit still saw decent growth.
Yep, up 25% year over year. So the underlying profitability engine is still improving despite the cat losses.
All right, let's zoom in a bit on Lemonade Car. Sounds like that's really starting to become a story.
It really does. For the first time, the quarter-over-quarter growth in car insurance premium, the IFP, it actually outpaced the rest of the business.
That is interesting, a potential inflection point.
Could be. Their whole strategy there seems to revolve around, two things. Their LTV models and telematics.
Lifetime value and driving data, basically. Finding those good risks, especially younger drivers, maybe?
Exactly. Identifying and pricing them accurately using data traditional insurers might not have or use as effectively. And the potential pool is huge.
How huge?
They have, 2.5 million customers without their car insurance?
Okay.
Who are spending over $3 billion a year elsewhere on auto insurance. That's the cross-sell target right there.
$3 billion. Wow. And they're using tech to capture that. You mentioned telematics.
Right. They talked about day zero telematics experiments, basically using driving data very early in the, quote, process.
And the results.
Reportedly, a 60% jump in conversion rates. So pretty impactful, though still early days.
And that feeds into cross-selling generally.
Seems like it. Cross-sell volume more than doubled year over year. They said optimized bundling flows helped a lot there. Getting people to take multiple policies is crucial.
Makes sense. And they're expanding where they offer car.
Yeah, they just launched in Colorado. That brings them to covering over 40% of the U.S. auto market by premium. And maybe more importantly, almost 60% of their existing customer base can now get car.
Now, the loss ratio for car is still elevated, they said?
It is, yeah. Typical for a young book of business like this, but they stress the older cohorts, the ones who've been with them longer, are performing well.
And they expect improvement.
They do. Double-digit improvement in the loss ratio expected at renewal for those policies. That's definitely something investors will be watching closely.
Okay, let's pivot back to the overall financials. In-force premium, the total active policy value.
Strong growth, up 27% across the $1 billion mark.
Big milestone. And customer numbers.
Also up nicely, 21% growth to hit 2.5 million customers.
And the average premium per customer. I know that's been a focus.
Up 4% year over year, now $396. They said that's mainly driven by taking rate, increasing prices.
Right. Now, annual dollar retention, ADR, that dipped a bit to 84%. What was the story there?
Yeah, they addressed that directly, said it was largely due to intentional actions to improve profitability, basically, non-renewing some less profitable home policies, and also dialing back on the pay-per-mile car product.
So strategic dip. They expect it to normalize.
That's the message, yeah. They expect it to stabilize going forward.
Okay. Gross earned premium.
That grew 24%, hit $234 million. And revenue followed, up 27% to $151 million.
What drove the revenue growth besides just the premium?
Well, the premium growth was the main part, but also a slightly higher effective commission rate they earned from their reinsurers and a pretty significant jump in investment income, up 26%.
Got it. Gross loss ratio overall was 78%, slightly better than last year.
Just slightly, yeah, down from 79% in Q1 24. But again, taking out the impact of catastrophes, mostly those wildfire.
The ex-Senate number.
Right, the ex-Senate gross loss ratio was much healthier at 59%.
And they also mentioned a benefit from prior period development.
Yeah, favorable development basically means past claim estimates were a bit too high. That gave them an 8% positive bump in the quarter.
Okay, so adjusted gross profit up 25%, we mentioned that. But operating expenses, ex claims, were up quite a bit, 29%.
They were, driven primarily by two things. That big jump in growth spending we talked about, and also an assessment related to the California Fair Plan.
Ah, the state insurer of last resort. Okay. How much was the growth spend?
$38 million in Q1. That's nearly double the prior year's Q1 spend. Tech development costs were up more modestly, 5%, G&A up 20%, but mainly due to higher interest expense.
And headcount? Still pretty lean?
Pretty stable, yeah. Up only 2% to about 12,260 employees.
So bottom line, net loss was $62 million.
$62 million net loss. Yeah, that's 86 cents per share, wider than the $47 million loss last year.
And adjusted EBITDA loss also widened.
It did. $47 million loss compared to $34 million a year ago, largely reflecting that increased growth investment.
But they finished the quarter with a healthy cash balance.
Oh, yeah. Still sitting on roughly $996 million in cash equivalents, and investments. Plenty of runway.
Okay, let's look at the guidance. What are they projecting for Q2?
For Q2, they see in-force premium landing between $1.061 and $1.064 billion. Gross earned premium, $246 to $248 million. Revenue, $157 to $159 million.
And the adjusted EBITDA loss for Q2?
Expected between $44 and $41 million, so slightly better than Q1's loss.
And for the full year 2025, any changes there?
Minor tweaks, mostly upwards. Full year IFP expected $1.203 to $1.208 billion. Gross earned premium $1.028 to $1.031 billion. Revenue $661 to $663 million.
And the full year adjusted EBITDA loss guidance?
Tightened slightly and maybe a touch better at the midpoint, now expecting a loss between $140 and $135 million for the full year.
And just to reiterate that key timeline, adjusted EBITDA positive by Q4 2026.
That's the plan they keep stressing, yes. Let's talk cross-sales again. They seem very focused on getting customers to buy multiple products. What's the goal there?
Well, the long-term aim is pretty ambitious. They're talking industry-leading rates, maybe in the 30s or 40s percentage-wise for multi-line customers. Wow. And near-term? Say 5 years.
They think approaching the teens is realistic on a 5-year horizon. And they pointed out in states where they already offer the full product suite, they're actually near 10% multi-line already.
So the potential is there as they roll out products everywhere.
Exactly.
Yeah.
State coverage expansion and leveraging those telematics insights are the keys, they say. And more cross-sales should help moderate that growth spending over time.
Okay. What about external factors, like tariffs? Any concern there?
They're watching it, particularly for imported auto parts, obviously. Their estimate, say 25% tariff could push up loss trends by a few points, single digits.
And the plan?
Plan is just to bake that into rates if it happens, to keep the loss ratio stable. They said the current guidance already includes a small assumption for tariff headwinds.
Got it. And back to the California wildfires for a second. Any updates on recoveries?
Yeah, some positive news there.
Yeah.
They sold the subrogation rights for one fire, the Eaton fire, which brought in $8 million. And they think there might be more potential recovery from another one, the Palisades fire. Plus, they expect to get back up to half of that fair plan assessment they paid, but that'll be spread over the next 2 years.
All right. And the growth spend going forward. You mentioned $38 million in Q1.
Expecting something similar in Q2, around $45 million. Might tick up slightly in Q3, then dip in Q4. For the whole year, they're guiding to around $170 million total.
And is that spending still efficient? Getting harder to acquire customers?
They claim efficiency in online ads is holding steady, similar to prior periods. They did mention a shift, though doing a bit more brand spending, like ads in public spaces in key cities.
Interesting. They talk a lot about AI. Is that translating into a real advantage, do you think?
Well, they certainly believe so. Their argument is that their AI and digital-first setup lets them collect better data and act on it faster. More precise risk pricing, lower costs.
And the proof?
They point to that improving operating leverage we discussed earlier as evidence it's working in practice.
Makes sense. And are they still filing for big rate increases everywhere?
The focus seems to be shifting a bit, less about broad strokes increases, more about refining the pricing, using data to match individual risk behavior to the rate more precisely.
So lots of smaller, targeted filings and experiments.
Sounds like it. Constant iteration. They did estimate, though, that about a third of their recent premium growth came from rate hikes plus upsells and cross sales.
Okay. And just to circle back on that retention dip, the ADR, it was definitely strategic non-renewals.
That was the explanation, yeah. Calling the book for better profitability, especially in catastrophe-prone areas for home insurance.
Which probably helped during those wildfires.
They implied as much, yes. Said those non-renewals provided significant benefits during the California events. And again, they expect ADR to level off now.
Right. And the telematics at point of sale, the 60% conversion boost, how widespread is that?
Still very early days. Sounds like it's in an experimental phase. They're fine-tuning it before rolling it out more broadly, but promising initial results.
And one more on car, where are new sales coming from? Existing customers or new ones?
The mix is shifting. Now, apparently, about half of new car sales are coming from existing Lemonade customers. That's up from around a third previously.
That's a good sign for the cross-sell engine starting to work.
Definitely. And their overall multi-policy rate is creeping up, approaching 5% now. Oh, and the Chewy partnership.
Right, the pet partnership. Still going strong.
Yeah, they said it's strong, generating lots of policies. There was some noise about a terminated contract, but that was just related to a warrant structure. Changing the partnership itself is solid. Payments just shifted back to cash.
Okay, so pulling it all together from an investor perspective, what are the main takeaways here?
Well, I think you see strong top-line growth, yes, but coupled now with that expense discipline, that suggests, increasing efficiency and a clearer path towards profitability eventually.
And Lemonade Car seems like a real potential growth engine.
Absolutely. The accelerating growth there, the improving cross-sell, that points to a big opportunity for future expansion and just getting more value out of each customer over time.
They also seem to be managing risks like the tariffs and wildfires pretty proactively.
Right, demonstrating resilience and a focus on keeping those loss ratios stable, which is crucial for an insurer.
And the continued pretty heavy investment in growth suggests they're still confident.
It does. Confident that their LTV models are right, that the AI-driven acquisition works, and that these customers will be profitable long-term.
Plus, the focus on refining pricing with telematics shows they're not standing still on the underwriting front.
Exactly. It's a dynamic, data-driven approach.
All right, now for our segment we call This Is Not Financial Advice. Got any interesting, maybe slightly out there trade ideas based on this call?
Okay, here's one to chew on. Strictly hypothetical, of course. You see Lemonade pushing hard into auto, claiming superior tech and pricing with AI and telematics.
Yeah.
What if you considered a long position in Lemonade, betting on that tech advantage and their path to profitability by late 26, paired with a short position against, say, a basket of traditional legacy auto insurers?
Ones with older tech.
Exactly. The thesis being that Lemonade's precision pricing starts to really bite over the next, say, 18-24 months. They peel off the profitable customers, hurting the incumbents who are still using broader risk pools.
And that accelerating car IFP growth could be an early signal.
Could be. It's definitely a high-risk, high-reward idea. It needs tons of your own research, naturally, but it's a thought based on the narrative.
Interesting angle. Okay, so wrapping up our deep dive on Lemonade's Q1 25 call.
Yeah, I think the main message is execution. They seem to be delivering on the growth strategy, and importantly, with increasing efficiency showing up in the numbers.
The AI platform, the momentum in car, and that disciplined approach to costs and risk those feel like the key things for investors to track.
Agreed. And as always, we definitely encourage you to check out the actual shareholder letter for all the detailed financials and think about how these points fit into your own view.
So what are your thoughts? Is Lemonade on the right track? Can the AI model deliver sustainable profits? We'd love for you to continue the conversation.